Hi, this is Roger Conrad. I'm editor of Canadian Edge. You know, I answer all my viewer email and take great pride in doing that. And one reason that I like answering the viewer emails is because I get a lot of perspectives on where a market is going. And one thing that I've noticed, what really stands out to me right now, is there's a lot of fear out there. A lot of investors are saying, hey, look at these gains we made over the past year. Can't they unravel? Isn't this economy poised for a double-dip recession? Aren't we heading for a big market collapse like all these big Wall Street firms are increasingly saying? And there's almost a consensus now saying that this is what's ahead, and investors need to batten down the hatches. This is I think people have a lot of reason to be concerned. Some people are worried about the health care bill. Some people are worried about the potential for higher taxes. I think that's almost a given down the road. But the unfortunate thing is the solution a lot of people are choosing here is a strategy that is almost certain to end in disaster. And what I'm talking about here is the strategy of placing stop losses, and particularly trailing stops. What's a stop? Well, it's basically an order, an automatic order, to sell a security that you own if it should breach a certain price level. And if it breaches that price level, you're not guaranteed to be taken out at that price. You're going to be taken out at whatever price the market's going to bear. What we've seen recently is a lot of people putting these stops in, and a lot of them putting them in at pretty much the same prices. So they all get breached at once. What's the result? Well, a waterfall decline. A lot of stock coming on the market at the same time. And it usually happens at a time when the stock is softened up a little bit. Maybe there's a brokerage downgrade of a security. Maybe there's an equity issue, something of that nature that raises some fears of dilution. Maybe there's even some earnings that came in that were very strong, but of course the market looks ahead, never behind. So buy on rumors, sell on news. Any number of things can happen to very strong companies. And of course, we're very much convinced, we've just had another round of earnings, that all of our picks are in that category as very strong companies. But any number of things can happen to the share prices of these things and take them down for a day, take them down a few points. Again, what happens if you have a stop in place and that's been executed? Then you come out of the trade. Chances are you're going to get it in a very, very bad price because there's going to be a lot of other stops coming in right behind you. Now, how can you avoid this type of action to your securities? A lot of people have taken the point of view, well, can you warn me ahead if there's going to be an equity issue, if there's going to be a brokerage downgrade? You can kind of make an estimate when there are more brokerage downgrades or when there's going to be more equity issues. There are more equity issues, for example, when share prices go up. Companies take the advantage to issue capital so they can grow, so they can pay down debt, a lot of different things. But they're going to want to issue capital when their share prices have gone up. So this is an ideal time for that. We're seeing a lot of that going on right now. When do brokerages issue downgrades? Well, when prices go up is one reason. Maybe a particular analyst's target has been hit. Maybe the stock has gone beyond that target. He's going to tell his clients to back off on it. Who are his clients? Mostly institutions who are dealing lots and lots of money around, and hitting these points is very, very important for them. How important is it for you, the individual, to hit these points, to get hit a point, sell out, get back in a point lower? Not very important, and in fact, you're going to wind up with a lot more transaction fees and taxes if you adopt that strategy. So that's not a good strategy. Another reason brokerages will downgrade something is if they see something that's bad in the overall economy, or they see something bad in the economy hitting this particular company. And of course, there's a lot of opinions on the economy. There's an old saying, look, show me a one-handed economist, because economists are fond of saying on the one hand, on the other hand. But this is rarely a good opportunity to bail out of something. And in fact, most brokerage downgrades occur after bad news has already come out. So if you're following these things as an individual, I think it's not a good idea. I think you want to make up your own decisions. And again, you want to keep your mind on the underlying business of that company. Is it paying its dividend? Is its balance sheet strong? Is it covering that dividend by a good amount? Is it increasing that dividend? How much proof are its assets and its cash flows against a downturn in the economy? And again, all these companies have proven that. in 2008, the worst credit crunch in 80 years, one of the worst downturns in the market, a gripping recession. So again, they've proven themselves, and some sort of a downgrade is not usually not a good reason to sell. So again, we're not complacent. We're looking at these things every day, but these are rarely good opportunities or good reasons to sell when you get these downgrades. So by locking in these stop losses, you basically guarantee that you're going to be taken out when there's a brokerage downgrade, when there's going to be an equity issue, and some of these other factors that, again, really don't have a whole lot to do with a total return. An equity issue can be the most positive thing for the underlying company if the money's deployed the right way. And again, they're issuing stock at a good time, which is what many of them are doing now. So again, I can't emphasize enough, I think this is really a bad strategy for people to follow. There are times to sell stocks, again, when the underlying businesses seem to unravel. They give us a lot of information, but we've just been through a lot of key information here. And looking at the economy of Canada, which has really emerged as a star in the global firmament, and growth picking up, these companies are actually no longer really moving against the wind. They're getting some nice tailwinds. And again, of course, the banking system in Canada has always been supportive, and the banks are doing better than ever. So again, there can be problems with individual companies, but there's absolutely no reason to start abandoning these companies now. And again, you put in stop losses, you may think that you're being smart and holding on to positions and hanging in there, but actually you're probably setting yourself up to get taken out, again, at lousy prices of good securities. So you can go in then from these trusts and other companies yielding 6, 7, 8, 9, 10%, even more, to money market funds yielding 0.5%. Again, that's kind of retirement or investor doom. So that's all I have to say today. Again, thanks for tuning in. I'll look forward to chatting with you next time, and we will have a Canadian Edge issue, a new issue up in a couple of weeks. Thank you.